Basically, there are now two ways of qualifying for the contributory old age pension. It's based on your contributions, paid contributions and credits. Now, you can get a credit if you say you're out for a week or a number of weeks or months or whatever on social welfare. You get credits for those periods of time. Now, the old system, which is still in place largely, is called the averaging system. It means that there are two criteria to qualify for contributory old age pension. First of all, you must have 520 contributions paid. That's 10 years contributions. Secondly, and if you have 10 years contributions paid, then you move on to the second part, and the second part is that you must have an average since you first paid contributions up to your 66th birthday. You must have a certain average amount paid. To get the full pension, it's 48 average. You divide the number of contributions by the number of years since between your 66th birthday and when you first entered into insurance. That figure must come out at 48 in order for you to qualify for the full pension. However, if it comes out at less, you can qualify for a smaller amount, and there's gradually a sliding scale. If your average is below 10, that average is below 10, you don't qualify for the contributory old age pension. A new method has now been introduced as well, and the department will look at every application to decide which is best for the pensioner, to apply the new method or the old method. The new method is called the total contributions approach, and it means that 40 years contributions would come to 2,080, and they will look at your contributions. Now, this is an alternative to the earlier system I mentioned. They will look at your contributions and see what percentage you'd be entitled to. To take the simplest example, if you have 1,040, which is half 2,080, you'd qualify for half-rate contributory old age pension. Now, to add to the complications, the new system is being gradually introduced. It'll be fully in place. The total contribution system will be fully in place from 2034 onwards. That's a good distance, 8-9 years into the future. But a small portion, I think it's about 20% of your claim, is now taken exclusively under the total contributions system, and the rest of it will be averaged, and that will continue on. The percentage will continue on for applicants next year and the year after and the year after, etc. So, the PRSI for the self-employed came in back in 1987-88. So people who are self-employed, such as farmers, doctors, etc., anybody who's in the self-employed category, their entry into insurance, if they were always self-employed, their entry into insurance would be taken as the year 1987-88, when they first started paying PRSI as a self-employed person. If they had been in employment before that, however, and they'd been paying ordinary A contributions, the relevant type of contribution to qualify you, that can be added on to whatever self-employment contributions they have to determine the rate at which they pay the pension. People have often asked me, can they pay voluntary contributions to bring their pension up to a certain level? Yes, that facility is there. There are a number of conditions attached to it, and there is a time limit as well within which you have to apply. But if anybody wants to contact me, I'll explain all that to them. There are a number of changes in relation to people who are caring. If you can show that you are caring for a child under the age of 12, or for a person with disability over the age of 12, you can claim up to a maximum of 20 years contributions for that. For example, a woman who stays at home to look after children, etc., or somebody who stays at home to look after a family member who's ill or disabled. Now, that maximum 20-year period only applies to determining the rate of pension you're going to get. You'll still have to have paid the 512 contributions. However, there's one exception has been introduced to that now. If you can show that you've been caring for somebody for at least 20 years, you can apply for a pension based on that. Now, you don't have to be actually getting the carers allowance for the full 20 years if you can produce medical evidence or whatever evidence they look for that you actually were caring for the person for at least 20 years. You can apply for a pension based on that. Now, 20 years obviously would give you about half rate pension on the total contribution system. But if you had any stamps paid apart from that, that can be added on to determine to get you a higher rate of pension. So that's basically all I want to say about contributory pensions at the moment. It's a lot to take in, but people should consider when they're applying whether they can apply for any, whether they can avail of any of these concessions. Now, the non-contributory pension, of course, is for somebody who doesn't have sufficient stamps plus credits to qualify for the contributory old age pension. The big thing with the non-contributory pension is that there's a means test. Now, it may be that somebody would have enough stamps to qualify for a reduced rate of contributory old age pension. It might be in their interest to look for the non-contributory instead, particularly if they have little or no means, because it may come in higher than the reduced rate of contributory. The big thing about non-contributory old age pensions is that there is a means test. Now, a lot of people don't seem to realise that under the new rules, an individual can earn, provided they're in insurable employment, they can earn up to €200 per week without that being taken into account for means, and their spouse, similarly, they can also earn €200 per week. Now, that does not apply, that concession does not apply to self-employed people, such as farmers, etc. The reason for that, frankly, escapes me. I don't know what, I can't indicate the justification for that, but for an employee, if they're in insurable employment, they and their spouse can earn up to €200 per week without this being taken into account for when they're calculating their means. Now, the other thing is, people have often asked me, if they sell their house, let's say somebody whose partner or whose spouse has died, and they're living in a big house and they want to downsize, or they want to move into one of those villages for the elderly, etc., and they get a big sum of money for their house. Is that counted as their means? The rules state that the first 337,000 of that is not counted. 337,000 will not be taken into account as means. The big complaint we always get in relation to the means test for non-contributory pensions is how capital is calculated. Now, capital consists of money in the bank. It can be shares. It can be a house other than your family home, a second house. By the way, if you have a second house and you have it rented out, it's the rent that's taken into account. Whereas if it's not rented out, if you're not renting it out commercially, it'll be the capital value that'll be taken into account. I find usually it's much more advantageous from the point of view of a person's means and what they'll get by way of pension if it's the rent that's taken into account, for reasons I'll come to now in a moment. Anything else, like a piece of land, a couple of acres of land, even a derelict site, etc., there's a capital value put in all those things, and that is means tested for non-contributory pensions purposes. Now, the way the means test works is, for an individual, the first €20,000 is disregarded. The next 10,000 is regarded as means of €1 per week. The next 10,000 after that is counted as €2 per week. In other words, say take the first 20,000, then next 10,000, €1 per week. Next 10,000 is €2 per week. So for somebody who's capital of 40,000, they will be assessed with means of €30 per week. That means that their non-contributory old age pension will reduce by €30 per week. The real difficulty comes then when you go over the 40,000. Every thousand over the 40,000 is counted as €4 per week. So take an example. Suppose somebody has a property worth, say, 100,000. The first 20,000 will be exempt. The next 10,000 will cost you €10 a week. The next 10,000, 20, but the balance will cost you 240. So for somebody with 100,000, your assessed means of 270 per week, which means you won't get any or very little non-contributory old age pension. Interestingly, I did a small calculation which I think is very interesting. If you take 270 per week over the year, it gives you a sum. It gives you a sum, a certain sum of money, which means that you're getting, which is equivalent to 14% interest on your 100,000. Like if you put that 100,000 in the bank, you'd get less than 1%. You'd get less than 1,000. According to the Department of Social Welfare's calculation system, it's worth 14% to you, 52 times 270, which is quite over 14,000, which is quite bizarre. It's a rule that badly needs to be changed, but successive governments have resisted change, I think largely because of the cost involved. But I mean, the vast majority of pensioners now are contributory pensioners, so the cost shouldn't be as big a factor as it was previously.